Good morning, everyone. I have that it is 9 o'clock on the button, so we're going to go ahead and get started. Welcome to the mid-career checkup for year 2000 plan members. My name is Julie West, and I will be your host this morning. I'll be the presenter for the MPERS portion of the webinar this morning, and then for the well, I was going to say for the afternoon. There is no afternoon. I'm sorry about that. After me will be Don Wilson from Deferred Comp. He will have something to show you and to present to you. Now, the presentation today is for those who have between 5 and 15 years of service or are between 6 and 15 years out from their actual retirement date. What I'm going to do is I'm going to go ahead and hide my webcam just so that it takes up a lot of bandwidth sometimes. So I'm going to go ahead and turn that off. So give me just a moment. If you are within 5 years of retirement and just wanted to attend today, just know that pre-retirement seminars and webinars, you probably want to attend one of those. We do have a pre-retirement webinar for closed plan and year 2000 plan members, and it is recorded and it will be posted on the website. If it is not already, it will be posted shortly. So there are things that you will need to know to make certain retirement decisions that we won't be discussing today in this mid-career checkup, just because at this point, if you're mid-career, you know, retirement is on the horizon, but it's not close enough to where you would need to go to a pre-retirement seminar. If you are interested in going to a pre-retirement seminar or webinar, you can log into your MyMPERS and you can go ahead and register for one there. Now, MPERS administers 3 different retirement plans. This one is, like I said, just for the year 2000 plan. We wanted to offer this webinar to those who are just in the year 2000 plan to share your benefits and not to confuse any of your options with the other 2 plans, the closed plan or the 2011 tier. But there are other options available for those plans as far as webinars go as well. I do have a few housekeeping items that we want to discuss. I want to let you know that everybody is muted except for me, because I'm just that special. Everybody is muted so that the background noise and stuff from everybody's mics won't be a distraction for us. We have Bev Wilson. She is joining us this morning as the moderator. So as we proceed through the webinar, if you have any questions, please feel free to share them in the questions box on your dashboard, your GoToWebinar dashboard. Bev will answer them as I continue with the presentation. And then at the end of my part of the presentation, we will check in with Bev to see if there's any questions that came in that, that would be worth sharing for the whole group. Now, there will be a survey at the end of the webinar, so please complete it. We do love to receive your feedback. And if for some reason you don't have time for the survey today, a reminder will go out for you tomorrow, and it'll also have a link to the recording of this webinar. Now let's review the GoToWebinar dashboard just briefly, just so that you're familiar with it. I'm going to get my laser pointer here. So this red arrow right here allows you to collapse or expand your dashboard depending on if you have enough space to view the background, view the slides. You can expand and collapse. This is mute or unmute, but like I said, you are muted, so you will not be able to unmute yourself. This allows you to see full screen, or if you want to collapse it back down, you can. This is a raise and lower hand, but really that's for if you had a question, but for our purposes, your questions are going to be typed into the questions box, and we'll cover that in just a second. You do have a few audio choices, so if for some reason you lose audio at some point, you can come here to this little selection here, select no audio, and then go back to computer audio, and hopefully that will fix it. But also make sure that down here, your speaker output is what you need it to be. If you want it to be in a headphone, if you want it to be in out of your computer, then you can do that there. We do have a couple of handouts in the handout section. One is for deferred comp. You should have received an email from me yesterday that also had the deferred comp handout. You will need that because you'll be following along with that in Dawn's presentation a little bit later. And so they also provided a copy of their slides, and so I put that in the handout section as well. This next box is the questions box. If you have questions throughout the webinar, please go ahead and type them in. You'll enter here and send, and then Bev will answer those as soon as she can. If you have questions for Don, I don't think he has a moderator, so just kind of keep that in mind. He may not be able to answer your question right away while he's presenting, but he will probably answer them towards the end of the webinar. All right, so let's meet the benefits team. This is Mary Jordan. We're going to start with her. She's been with MPERS for over 27 years, and she's been served in various roles, but for the last 16 years, she's been or 17 years, she's been a benefit counselor. So she's has a wealth of knowledge there. This is me. I'm Julie West. I am a benefit counselor. I actually have been at MPERS for a little over 6 years. I started as the communications specialist, and last fall I transitioned into a benefit counselor position, and I really enjoy it. So I'm happy to be here and happy to help you guys out with your retirement decisions. And last but certainly not least, we have Bev Wilson. She's our benefit auditor. She's been with MPERS for a little over 21 years, and she makes sure that all of the numbers are correct. So for benefit payments going in and out. And so we really appreciate Bev and her knowledge and her attention to detail. If you give us a call at MPERS and you request an appointment, or if we do seminars, webinars, chances are you're going to get one of us three. We are the three that handle all of benefit questions, meet with employees one-on-one, and help you with your retirement process. All right, so let's get started. The great George Foreman once said, "The question isn't at what age I want to retire, it is at what income." And that's the purpose of our webinar today, to get you to think about what your retirement income picture will look like when you do finally reach that glorious moment of retirement at the end of your career. Now, retirement income in general doesn't come from only one source. If you are relying strictly or only on your MPERS pension to sustain you throughout your golden years, or only to your future Social Security benefit, then you may want to take a closer look at your retirement income puzzle and the different pieces that will make up your retirement income package. When considering what your future retirement income may look like and where it will come from, there are three main pieces of the puzzle as a state employee: your pension benefit from MPERS, your personal savings, either through MoDOT deferred comp or another savings vehicle, and your Social Security benefit. If you have other sources of income as well, they are definitely a part of the puzzle, but we're going to focus on the first two pieces mentioned today: your MPERS pension benefit and MoDOT deferred comp. We will briefly mention Social Security at the end of the presentation, but that's not our area of expertise, and you'll need to research your own options for Social Security independently. So MPERS is a defined benefit plan, or what is commonly referred to as a traditional pension. MPERS has three defined benefit plans: the closed plan, the year 2000 plan, and the 2011 tier. The plan that you're in is determined by your initial hire date in a benefit eligible position with the state of Missouri. You are a closed plan member if you are hired before July 1st of 2000. If you are hired on or after July 1st of 2000, but prior to January 1st of 2011, then you're in the year 2000 plan. If you were hired after January 1st, 2011, then you are in the 2011 tier. As I already mentioned this morning, though, this webinar, we will only be looking at the year 2000 plan. If you'd like to know more about the 2011 tier or the closed plan, there are other webinars available for those plans. One of the characteristics of a defined benefit plan is that the benefit is not determined by how much the employee contributes to their retirement. In a defined benefit plan, future benefits are determined by a formula that is set by law. The year 2000 plan uses the same formula as the closed plan and the year 2000 or the 2011 tier. The formula used to calculate future retirement benefits includes your credited service, a multiplier that's set by law, and your final average pay. These components multiplied together give you a lifetime base benefit amount. Another characteristic of a defined benefit plan is that the retiree will receive the benefit for their lifetime. And if the retiree chooses a survivor payment option at retirement, then after the retiree passes away, the benefit is payable for the survivor's lifetime as well. We'll dive deeper into the formula in the next few slides. So if the retirement benefit is for a lifetime, how is it funded? Well, another characteristic of a defined benefit plan, it is that it's not solely up to the employee to fund their future retirement benefit. Your retirement benefits are funded by your employer contributions. So your employer is contributing to your retirement on your behalf. It's also funded by MPERS investment earnings. We have an excellent investment staff that has put together a diversified portfolio to manage our investments and mitigate the risk and also make the most of profitability during market upswings. The last piece is employee contributions. Now, your group, the year 2000 plan, as well as the closed plan, they don't have employee contributions component to this, but the 2011 tier does. As mentioned previously, the year 2000 plan, is a defined benefit plan in which future benefits are determined by a formula that's set by law. So remember that formula consists of credited service, the plan multiplier, and your final average pay. Credited service can include service worked, service purchased or transferred, and unused sick leave. The multiplier, which is set by law, is 1.7% on the year 2000 plan. Final average pay is calculated using your highest 36 consecutive months of pay. We will survey your entire salary history to determine your period of final average pay. Often it's towards the end of your career, but sometimes it can fall at an unexpected place in your career due to receiving maybe an overtime or comp time payout. So let's take a look at how a year 2000 plan benefit calculation may look. So just as an example, we have credited service of 28.5 years. The multiplier for the year 2000 plan is 1.7% or 0.017 in decimal form. And this person has a final average pay of $3,000. When we multiply all of the components together, the base benefit for this individual will be $1,453 per month. Now, the year 2000 plan has the potential for an additional component called the temporary benefit. If this member retired directly from active service and retired under normal retirement guidelines prior to age 62, then they will receive the temporary benefit in addition to the base benefit, but only until age 62. To calculate the temporary benefit, we use the same credited service and final average pay. However, we change the multiplier to 0.8% or 0.008. In this example, the temporary benefit amounts to $684. When you add the base benefit of $1,453 and the temporary benefit of $684 together, the new base benefit would be $2,184. $1,237. Now remember, the temporary benefit ends at age 62, so the benefit will appear as if it decreases at that time. In reality, that extra temporary benefit will stop and the lifetime benefit will continue. Some may look into drawing early reduced Social Security at 62, and that's really your choice if you want to do that or not. But Social Security eligibility and your decision to draw at 62 or not is not directly related to that temporary benefit. So if you decide not to draw early Social Security, that temporary benefit is still going to stop. Some people, what they'll do is they'll also, if they're not wanting to draw early Social Security, if they have funds in their deferred comp, what they'll do is they'll take distributions from that deferred comp to make up for this temporary benefit until they are ready to draw Social Security. I'm sure Don might discuss that later in his presentation. Now for the all-important question, when can I retire? Well, there are certain age and service requirements that you must meet before you can actually retire. The year 2000 plan has a 5-year vesting requirement, which means that once you've worked in a benefit eligible position for at least 5 years, you're eligible to receive a future retirement benefit. Each of our plans has different age and service requirements that would make you eligible to retire. And the requirements can be different for our uniform patrol members and non-uniform members. When looking at eligibility requirements, there are 2 types of retirement. We have a normal retirement and early retirement. For our uniformed year 2000 plan members, they will reach normal retirement eligibility when they meet the rule of 80 or when they reach age 60, regardless of the amount of service. Uniform patrol have a mandatory retirement at age 60. Now let me explain that rule of 80. The rule of 80 is met when a member's service plus their age equals 80. However, the minimum age to retire under the rule of 80 is age 48. So if you happen to meet the rule of 80 when you're 47, you're still not eligible to retire. You have to wait until age 48. Uniformed year 2000 plan members may be able to retire early if they have at least 5 years of service at age 57. But keep in mind, early retirement is sometimes referred to as reduced retirement because it does reduce your monthly benefit based on how many months prior to normal retirement that you choose to retire. Non-uniform members includes MoDOT employees as well as civilian patrol employees. For our non-uniformed year 2000 plan members, they can reach normal retirement eligibility at age 62 with at least 5 years of service or when satisfying the rule of 80. The same rule of 80 requirements apply here as well. When a member's age plus their service equal 80, they're eligible to retire, but they have to be at least 48. Non-uniformed year 2000 plan members may be able to retire early if they have at least 5 years of service at age 57. But keep in mind that with early retirement, there is that reduction in your monthly benefit. The benefit is reduced 0.5% for each month that you retire early before your normal retirement date. Also remember that that rule of 80 is only an option if you retire directly from active employment. If you leave prior to becoming retirement eligible, your retirement will be at age 62 for normal retirement or age 57 for early retirement. Now, I know you probably won't remember all of that because it's a lot of information, but if you would like to review those eligibility guidelines, you can do so on our website. If you go to www.mpers.org and then go to member education and then your retirement benefits, and under that you have a retirement eligibility choice. When you click on that, then you will be able to see the age and service requirements for the plan you are in by switching between the tabs in each section as needed. Notice the different options for normal and early retirement and non-uniformed and uniformed. Now, knowing eligibility requirements for the plan is one thing, but what does that actually look like to you? When is your projected retirement date? How can you track your credited service so that you know exactly how much time you have to prepare for retirement? Well, the best way to track your credited service and view your projected retirement date is to check out your MyMPERS Secure Member Access. If you go to our website, www.mpers.org, click the green button in the top upper right corner. It says MyMPERS Login to get to the login screen. Once you log in, your homepage will give you valuable information such as the plan that you're in, your first eligible date for retirement, as well as your service totals. Everything listed down the left side of the screen shows you everything that you can do as an active employee signed into your online account. You can run retirement estimates and view your annual benefit statements here as well. This is also where you go to register for any of our seminars. We're going to switch gears here just a little bit and talk about disability benefits. As an active employee, MPERS and your employer provide disability benefits through the standard insurance company. Why do I bring them up in this section that you may ask yourself, or you may not ask yourself, but this is why I bring them up now. It could affect when you are eligible for retirement. Disability is meant to bridge the gap between when you are no longer able to work and when you are eligible to retire. For example, if you are just a couple years away from being eligible to retire, and something terrible happens to you and you're no longer able to work, you could apply for disability. If you meet the eligibility requirements for disability and continue to be disabled, you could possibly stay on disability until you are eligible to retire. Once you're eligible to retire, you'd be required to retire at that time. Now, MPERS offers 3 types of disability. Long-term disability is for any illness, injury, or disease and may provide you with up to 60% of pre-disability earnings. Work-related disability is for any accident or injury on the job and may provide somewhere between 70 to 90% of your pre-disability earnings. Workplace Possibilities is a program that is meant to actually help you stay at work. When you are on a disability, you won't receive 100% of your pre-disability earnings, so 100% of your salary. Workplace Possibilities, what they do is they help assess your workstation and they help remedy what difficulties may be present so that you can stay at work and continue to earn your normal salary. Just to give you an example of Workplace Possibilities, let's say someone has back trouble and they've been treated by a physician. Our disability provider can send someone in to review your medical documentation and your workspace. They may look at your chair and determine that a better chair would help with the back issues. While it may not get rid of them, it will help alleviate them to help you stay at work. At no cost to you or your employer, they will purchase a new chair in an effort to alleviate those back issues. This is a one-time deal and you cannot be eligible for retirement and utilize this program. While you're continuing through your career, just keep that in mind that if you're no longer able to work because of a disability, that doesn't mean that you are not eligible to collect a retirement benefit in the future. As long as you are vested, you will still be able to receive a benefit when you become eligible. If you have further questions about disability benefits, please visit that member education section of our website that I pointed out just a little bit ago. All right, well, let's move on to the next part where we're going to look at the value of your benefit. Let's take a look at how it can accumulate and build over your lifetime. So retirees are eligible to receive an annual cost of living adjustment, is what we call a COLA, every year. The COLAs can vary from 0 to 5%, and they're basically tied to inflation. So in this example that we're going to look at, we have someone retiring under normal retirement eligibility at age 52, and they're retiring directly from active service. They will receive the temporary benefit until age 62, so that's 10 years of that temporary benefit. Their final average pay was $3,000, and they have 28.5 years of service. We will assume that this individual will receive a 2% COLA every year. Now keep in mind that the COLA amounts can vary from year to year because they're based on 80% of the rate of change in the Consumer Price Index, or the CPIU. And 2% COLA is kind of average for what our COLAs have been over the years. So that's why we included that 2%. So in the first year that they receive a benefit, their monthly benefit was calculated to be $1,453, and their temporary benefit was calculated to be $684. Since both the base benefit and the temporary benefit are eligible for cost of living adjustments, each year the amount the member receives may increase. This makes for a total monthly benefit of $2,137. We also have the annual benefit column at the end of this, so you can see kind of how it will build annually as well. Now in year 2, we see a base benefit increase to $1,482, and the temporary benefit increases to $697. In this example, each year the benefit increases 2%. Now keep in mind that 2% isn't a guaranteed COLA rate, it's the average COLA rate, and it can range from 0 to 5%. Now let's fast forward to, I think, year 9. Yes. So at year 9, the base benefit is up to $1,703, and the temporary benefit has built to $801. So the total monthly benefit is $2,504, and the annual benefit is $30,053.04. Now you'll notice in year 10 that temporary benefit column there is a 0. This is because that temporary benefit for this individual, they turned 62 and their temporary benefit stopped. So the month that this member turned 62, they still would have received that temporary benefit, and then the following month, they will not receive it. So if you take a look at that, you can see the difference in the income there. That's why it's kind of important to have a plan for when that temporary benefit stops. What are you going to do to fill that gap? Are you going to draw early Social Security? Are you going to take distributions from deferred comp or other investments that you may have or other savings that you may have? Because that's a pretty decent drop in your income right there at age 62. Now keep in mind that when the temporary benefit stops, any cost of living adjustments earned on that temporary benefit also stop. But your base benefit will continue with all of the cost of living adjustments for your lifetime. All right, let's fast forward. We're going to go to year 25. And so at year 25, sorry, my pointer is going kind of crazy here. So when we reach year 25, at that time you'll be receiving around $28,000 just from your pension. Okay, keep in mind at the beginning of this when we said your retirement income as a retiree is a puzzle, right? So this is just that pension piece. This isn't all that you're going to be getting in retirement income, because this is why we have these mid-careers, so you can plan and you can have an idea of how your pension puzzle piece is going to fit into that whole picture of your retirement income. So over this individual's lifetime, well, 25 years, they will have received over $639,000 in retirement benefits. Now, some of you may be thinking, wow, that's a lot. Others may be thinking, that's not much at all. But the important thing to remember is that this benefit is for your lifetime. So in this example, the person retired at age 52, and we projected this out 25 years. And so that's age 77. You know, we hope that you live longer than that. Some of you hope you do, some of you hope you don't. I don't know what your situation is, but if you live longer than that, then obviously your lifetime total will be even more. Now, if you also choose a survivor benefit payment option at retirement, when you pass away, that survivor will continue to receive your benefit as well. So keep that in mind. Now, if you think about, well, that's not that much, you know, the year 2000 plan is non-contributory. So as far as money goes, you didn't put anything into this future retirement benefit, this pension that you've earned. Whereas other places, you would have to save this much in order to actually get this much as a retiree. So if you're thinking it's not a huge pension amount, then how do you actually get more? What adjustments can you make early on that will help supplement that pension benefit from MPERS? So there are two possible ways in which you can get more when it comes to your MPERS pension. You can increase your credited service, and so you can work longer, or you can increase your final average pay. Now, how do you increase your credited service? Well, this could include working longer, and that one's kind of a given. Although that may not be appealing to some, it may be an option. Working longer, pretty self-explanatory. The longer you work, the more credited service you have, and the higher your benefit may be. Another option that you may have to help increase your credited service is to purchase or transfer previous service. And lastly, is converting your unused sick leave to credited service at the time of retirement. Let's take a closer look at a couple of these. So once you're vested, you may be eligible to purchase prior service. A benefit of this is not only to increase your credited service, but it may also change your retirement eligibility. Whether that is to allow you to qualify to retire earlier or get you started in a backdrop period sooner because of that earlier retirement eligibility date. The types of service you may be able to purchase or transfer will depend on the plan that you're in. So you're in the year 2000 plan. So if you have active or reserve military time, you may be able to purchase this service once vested, and the service had to be worked prior to the start of your state employment. If you decide to purchase service previous military time, you must purchase all that you have up to 4 years. Now, if you have previous non-federal public sector employment, you may be able to purchase full-time non-federal public employment that was worked in the state of Missouri. This could be employment working for a city or county government, a public school district, the University of Missouri system, or some special road districts even qualify. You may be able to purchase prior police service if it was worked in the state of Missouri, if it was under a city or county government. This would fall under non-federal public employment. The service we just discussed was service that may be able to be purchased. But what about service that may be able to be transferred? If you have previous state service with an agency covered by the Missouri State Employees Retirement System, or MOSERS, MPERS covers retirement for MoDOT and the Highway Patrol, and MOSERS covers retirement for all other state agencies, including some colleges and universities. So if you have previous service covered there, you may be able to transfer it to MPERS and not lose any of that credit. Just remember that service must have been worked in a benefit eligible position to be covered and eligible to transfer. If you have previous vested service with agencies covered under loggers, which is the Local Area Government Employees Retirement System, PSRS PEERS, which is the Public School Retirement System, University of Missouri System, Kansas City Employees Retirement System, or the City of St. Louis Employees Retirement System, you may be able to transfer that service to the MPERS system, assuming the service has not been forfeited with the other retirement system. If it has, then that service may now be eligible for purchase. Some service purchases are very costly, but the additional benefit that may be added over the course of a retiree's lifetime because of that added credited service may well be worth the investment. Additionally, it's generally less expensive to make these purchases earlier in your career rather than later, but you do have to be vested before you can do a purchase or transfer from anywhere other than Moser's. So there's a lot of moving pieces when we're talking about this subject, and everyone's situation is just a little bit different. So if you have questions about a possible service purchase or transfer, please just contact our office. We can help you with finding out if your service may be eligible for purchase, and if so, how much it will cost, and how it will impact your future retirement eligibility. All right, we covered how to increase credited service by working longer, everybody's favorite, yay, working longer, and using service purchases or transfers to boost your credited service. Now let's look at the last way to increase your credited service. Much like working longer, unused sick leave is very straightforward. When you retire, your unused sick leave can be used to boost your credited service totals. For every 168 hours of unused sick leave that you have at retirement, 1 month of credited service will be added to your total. If you have 167 hours, you won't be credited 1 month. If you have 335 hours, you will not be credited 2 months because you'd be just a little bit short. Now just remember, sick leave is there for you to use if you are sick. But if you tend to be on the healthy side and are accumulating quite a bit of sick leave, just know that when you retire, you could have quite a bit of service added to your total credited service for your unused sick leave. Also remember that sick leave cannot be used to reach retirement eligibility sooner. I've seen some pretty high sick leave balances that may give you a year, year and a half of credited service, and so they're hoping that will allow them to retire a year or year and a half sooner, and that is not correct. That's not how that works. It just gets added on for their benefit calculation purpose. Now, the second component of the benefit formula that you may be able to influence is an increase in final average pay. This could include pay increases, promotions, or comp or overtime pay you received while you're still working. Now, the final average pay used in the benefit formula is the highest 36 consecutive months of pay used, highest 36 consecutive months of salary. Sometimes this time frame may occur during the end of your career, but depending on any of these possible increases, such as comp time or overtime payouts, it really could shift your highest 36 to a different period in your career. Pay increases and promotions will affect your highest 36 consecutive months if they average out to be within your high 36, but sometimes it doesn't quite work that way. If you've been paid for any comp time or overtime, this may shift where your high 36 fall. Well, how will you know where your high 36 consecutive months of pay fall? Or at least have an idea where they may fall. So I want to direct you back to your MyMPERS Secure Member Access. One of the tools available to you there in your MyMPERS is a benefit estimate. You can run a benefit estimate based on your first eligible retirement date, or specific dates, termination dates, or even early retirement dates, which some may be eligible for. You'll also be able to enter a spouse's date of birth if you're married to be used to generate survivor benefit payment options on the estimate. When you're looking at the estimate, you can see down here where all of these yellow arrows are pointing that this will give you the time frame and for the final average pay for this particular estimate. So for this individual, their period of final average pay that was looked at was 11 of 2021 to 10 of 2024. You'll also want to remember that when you project an estimate into the future, that we don't assume any pay increases. They take your current salary and project it forward. So if you have pay increases in the future, then really that will only increase your benefit down the road. As mentioned earlier, there are three main pieces to your retirement income puzzle. Your MPERS benefit, which we discussed in this presentation, personal savings, which can be through Deferred comp, and Deferred comp will be the next speaker. Don Wilson will be here in the webinar to help you prepare and see how you can maximize your savings to help with your retirement income in the future. And then that final piece would be Social Security. As mentioned earlier, we won't go into a great detail about your Social Security benefit because we don't work for Social Security. And so, but if you'd like to get an estimate of what your future Social Security benefit may be, you can do so by creating a My SSA account through ssa.gov. That's Social Security's official website. Once you've created an account, you can get an overview of your account, review the annual statements they used to mail, and benefit estimates based on your retirement age with them. This may be helpful if you're considering your options for when the temporary benefit ends at age 62. Will your Social Security benefit at age 62 fill the gap when your temporary benefit stops? What is the difference between early and full Social Security age and the amounts? You can set up your account at any time to keep up with your retirement planning for that piece of the puzzle. One thing to keep in mind whenever you're looking at Social Security, when these estimates, it's taking into consideration that you're going to be earning your current salary still until you decide to draw Social Security. So just kind of keep that in mind. All right, we are finished with that MPERS portion. It was kind of an abrupt end of the presentation, but we are going to check in with Bev to see if she has any questions that came up. Are you there, Bev?
I am. We did not have any questions today. Must have covered everything well.
Well, fantastic. All right, thanks, Bev. Well, thank you all for taking interest in your future retirement benefit earlier in your career than 5 years out. If you have questions after this presentation, which we really hope that you do, please contact us. We're there for you. There are different ways to get a hold of us. You can visit our website at www.mpers.org. You can call us. We are in Jefferson City. Our number is 573-298-6080. The email address that we prefer you use is our benefits email. It's benefits@mpers.org. That email box is actually monitored by me, Bev, and Mary. And then we're also on social media. You can find us on Facebook, X, Vimeo, LinkedIn, and YouTube. All right, we have Don Wilson from Deferred Comp. He's going to be telling you and sharing with you how you can save more with the Deferred Comp puzzle piece of your retirement income. So Don, take it away.
Thank you, Julie. Good morning, everyone, and glad to be with you this morning. As Julie mentioned, I am with Deferred Comp, and this is going to be one piece of the puzzle that you might have. I know a lot of people may have individual retirement accounts. They have Deferred Comp. We are a 401k style plan is basically what Deferred Comp is, allowing us to set money aside, i.e. for retirement, as an employer-based plan. You know, Julie went through the pension with you. Social Security, I know she mentioned setting up an account at ssa.gov. And I would highly recommend everyone setting up an account with Social Security. Number one, to check your earnings history to make sure there has been no breach of your Social Security number, and also to play around with their estimates, especially if you're getting close enough to retirement. And I would highly encourage you, if you're married, looking at how spouses can play each other off regarding their different earnings histories and when one or the other might want to claim their Social Security benefit. And then we'll have the personal savings side, which includes Deferred comp. Like I said earlier, might also include an old 401k. You might have some IRAs. One thing about IRA accounts, whether they're traditional IRAs or Roth IRAs, they do not impact what you have through your employer, meaning your pension or your deferred comp. They are standalone benefits that we as employees who get W-2 income have the ability to contribute through our Deferred comp plan, as well as contributing to IRAs. And like I said, they're standalone benefits. They do not have to be coordinated in any way. So with Deferred comp, we are a 457 plan, basically for government employees, for city, county, and state employees. Deferred comp has been around since 1974, allowing state employees to set aside money for retirement. New employees, if you were automatically hired by the state and you were a new employee, you were automatically enrolled in deferred comp. Anyone who is new to state employment is automatically enrolled in deferred comp. Federal law changed a number of years ago, back in 2012, requiring employers to enroll employees in these retirement accounts. You have the ability to do a pre-tax contribution, tax deferred, meaning you're not paying tax on any of the funds that are being deposited in your account until you take it out at retirement. You also have the Roth option. This is the after-tax version. The word Roth is the guy's last name that sponsored this legislation way back in 1999, and it allows us to pay tax on what goes into that account. That becomes the contributions, or as the IRS likes to call it, the basis of your Roth account, money you've paid tax on. And you don't have to pay tax when you take it out at retirement age. The Roth accounts, I think, work great for younger employees because they have many years to save until retirement. And the investment growth is what we actually get back tax-free from the Roth account. One thing about 457 accounts that's different from all the other type of retirement savings account is the 457 plans do not have a premature distribution penalty, meaning if you were to leave employment, retire, or quit and withdrew your funds from your 457, that's what you and I contribute to as employees. There's penalty-free distributions. There is no 59.5%, 10% penalty associated with what the employee put in. Now there is with the employer portion, which is the 401 account when you look at your account online. There will be a 457, that'll be what you have contributed, and it can include both pre-tax and Roth contributions. 401 account is what the current, is what the state is matching on our accounts. As you can see here, that last bullet, state's matching up to $75 each month. It is actually, they'll match anywhere between $25 to $75 each month, 75 a month being the maximum that will be contributed to that 401 account. Also want to point out here too, that match money is a month behind. So we're here, I believe we received our match for January sometime this week. Legislation based it upon what we put in each month rather than each pay period. So if you go into that 401 account, you can look under transaction history and see the deposits that have been made on your behalf. But 457 is what we put in, 401 account is what the employer puts in for us. And we can change our payroll contribution at any time throughout the calendar year. With pre-tax, and this is a question I get quite frequently, pre-tax or should I do Roth or should I do both? Pre-tax contributions are going to reduce your W-2 income. However, you pay tax on it when you take it out at retirement age based upon your income at the time you take it out at retirement or whenever it is you take these funds out. Somebody puts $100 in pre-tax, let's say they're doing $100 pay period. Over 24 pays in a year, they reduce their W-2 income by $2,400. It would probably cost them around $80 out of net. Maybe there's about a $20 tax savings, but they'd have $100 go into their account. With Roth, you're saying, hey, I want to pay tax now. So if you were doing a $100 Roth contribution, technically you'd have to earn probably somewhere around $120 in gross pay to have $100 after tax to invest in your Roth account. But since you pay tax on those funds, you do not have to pay taxes when you draw it out. And the plan is keeping track of what you put into that Roth account, the contributions or basis, the money you've paid tax on. And like I said, it's the investment growth that we get back tax-free on these different, on these Roth accounts. And you can switch back and forth between pre-tax and Roth at any time. One thing with deferred comp, because it's an employer-based plan, everything you need for income tax purposes is on the W-2 form. You don't have to fill out another form to go with your return because you may have made contributions to deferred comp. It's all on that W-2 form. Those have to be entered into most of the CAN software, all the different entries, and they will have pre-tax and or Roth contributions listed on that W-2 form. And I'm going to concentrate here on the Roth. For Roth distributions to be tax-free, I point to the bottom right-hand corner of the screen. Roth withdrawals are tax-free once that account has been open for 5 years. All Roth accounts have to be open for at least 5 years, and you must be at least 59.5 when you draw out of that Roth account. If you meet both of those requirements, any distributions from these Roth accounts are considered tax-free income. Now in deferred comp, if you were to draw money out before 59.5, let's say you got the 5-year rule covered, but maybe you're not 59.5, you could retire earlier than 59.5. You can take a distribution from that Roth account. And if you're under 59.5, you will pay taxes on any of the investment growth that is distributed to you. And it will only be on any of the investment growth. Keep in mind, Roth accounts are made up of the basis or the money that you contributed and paid tax on, plus the investment growth, and that investment growth is the tax-free portion. But if you don't meet both these rules, only a portion of the investment growth that is distributed is what would be taxable. As I mentioned earlier, there would be no penalty. 457 plans don't have a penalty for premature distributions before 59.5. Now, pre-tax money or tax deferred money, you're paying tax on it when you draw it out at retirement age. It's going to be based upon your household income, the overall income tax liability on this tax deferred money. Folks who draw money out of deferred comp, we are required by our IRS regulations to withhold 20% upfront for federal income taxes. Most taxpayers, middle income payers, are going to be either in the 12% bracket or the 22% bracket. Not knowing which bracket you might fall in, they default at a 20% tax withholding. If your effective tax rate's not that high, you'll get some of that money back in the form of a refund when you file your income taxes. But you can do both pre-tax and Roth contributions. I talked with a couple of people this week who were dual income households, both meaning that they have both people are working. They're into that 22% federal income tax bracket, and they were looking for ways to reduce their current tax liability. They were doing Roth, but they saw what the income tax liability was on some of those dollars. So they were thinking of, hey, maybe I want to switch some of this to a pre-tax to help reduce my W-2 income and offset some of my federal taxes currently. Here are your annual contribution limits. These contribution limits today apply to all defined contribution plans, not only us 457 plans, but the 401ks and 403bs. Under age 50, annual contributions $23,500. You have a 50 and over catch-up provision of $7,500. And then you have, this is new, this age 60 to 63 catch-up provision, which allows those folks to add another $11,250 for a total of just over $34,000 in contributions. Keep in mind that these contribution limits do not impact an IRA limit. I had a question from a participant this week who was doing their taxes. They had put more than $7,000 into their Roth account with deferred comp. And they were saying they had reading online with their software saying the IRA contribution limit is 7,000. They were under 50. Well, IRA contribution limits are different from deferred comp. An IRA does limit contributions in a Roth account to 7,000, but this limit in deferred comp is totally separate from that IRA limit. And you can make Roth contributions to both an Roth IRA and to deferred comp up to the annual limits. And contributions can be done as a percent of pay or as flat dollar amounts. I'm a huge believer in using the percent of pay method to contribute. That way, your contributions keep pace with your income as you get promotions. Maybe you work some overtime throughout the year. It'll keep pace with your salary throughout your career. In this chart's just trying to illustrate a little bit of the difference between using a flat dollar amount or using a percent of salary. In practice, I see folks who are using the dollar amount, get some promotions, get pay raises, and maybe don't think to change their contribution at that point in time. But if they use the percent method, that contribution keeps pace with their salary over their career. And here's a new feature that was added a couple years ago, this automatic increase, which allows you to automatically build in increases in your contribution each year. And the auto increase tool can be used as a dollar amount or as a percentage, but this is showing the percent. As I mentioned at the beginning, new employees are automatically enrolled at a 1% contribution. Well, if that person set up a 0.5% auto increase over a 25-year career using 3 different starting salaries, what you would be contributing, or what your projected account balance would look like, over a 25-year career. And the right-hand chart is based upon a $30,000 salary, what that dollar amount would be using the different percentages. And if you were increasing at a 0.5%, what the different percentages would look like at different points in your career. A lot of people ask me all the time, how much should I be contributing towards retirement? If you're covered by a pension plan, you probably can get by with doing around 10% of your salary towards retirement. If you're somebody who doesn't think they'll stay with the state until they reach retirement, you probably want to get used to investing anywhere maybe between 10 to 15% of your salary. Because if you're in a 401k style plan, you're building your own pension through your contributions and potential employer contributions. Rollovers, this allows us to move funds around. If we change jobs, you can move your money with you. And I highly recommend when you change jobs that you do a rollover. Don't leave that money with the old employer's plan. Employers change record keepers from time to time. And employees, the former employee loses track of that account, maybe doesn't log into their online account for a while. They move, addresses change. I know it's very difficult. People are finding out that if they try to log into an old account that they've had for a while, and it's been a while since they've logged in, it can be somewhat difficult to reclaim that account. And the federal government is actually setting up a website for lost 401ks, people who've lost track of some of these old retirement accounts. And Deferred Comp can accept rollovers from all these other retirement accounts. Bring that money with you so that you can keep building upon that asset base. And if you have an interest in moving money to Deferred Comp, there is a Move Your Money link under the overview section of the website that asks you for some information about the plan that you have, the type of plan you had. It will also ask if you had pre-tax or Roth money in that account, because if you had both sources, you want to make sure you indicate that so they don't commingle Roth money with any pre-tax money. And with deferred comp, especially with auto enroll today, when you're automatically enrolled in deferred comp, they are going to put you into a target date mutual fund. And that target date is going to be based upon when you would reach age 65. So they'll put you into a target date fund closest to your 65th birthday. As you can see from the pie charts, the way these funds work, they're sometimes referred to as life cycle funds by some companies. They take into account where you're at in your career. The further you are from the retirement date, target date, the more growth oriented the portfolio, meaning it's going to have a higher percentage going into stocks. But as you progress through your career and you are working towards that retirement date, target date, the portfolio is going to slowly rebalance over time. It's going to get more conservative. So it'll be much more conservative at the target date by the time you reach that retirement date than it was when you were initially started. Now you can choose to be in any target date fund you wish to. You're not limited by that birthday, that age 65. I have some retirees who do not want to be as conservative as they recommend. They want to invest more aggressively. Likewise, I have some younger employees who don't want to be as aggressive as the target date might suggest, so they might pick a target date fund with an asset mix more to their liking. Stable income fund, this is our interest-bearing account. It has no stock market fluctuations. It's currently paying an interest rate of 2.59% on that account. Like I said, it's an interest-bearing account, no market fluctuations with the stock market. Some active employees will put some money into the target date fund for the potential growth, and then maybe use a stable income fund for the safety aspect of their portfolio. And then we have a brokerage window through Charles Schwab. This is going to open up the whole universe of investments to you. Stocks, bonds, mutual funds, ETFs, the whole 9 yards. And the way you set up a brokerage account is directly through the Deferred Comp website. There's a link on the website allowing you to set up a brokerage account. This brokerage account is considered an institutional account. If you were to say have a individual account with Charles Schwab, that would be considered a retail account. In your name, this is an institutional account through MoDOT Deferred Comp. If you did have a Charles Schwab account, Schwab will allow you to see both accounts on their website, but you can't commingle funds from the retail account to the institutional or the institutional to the retail account. And here are the fees to participate in MoDOT Deferred Comp. This is one of the big advantages of the plan, is low cost structure. I highly recommend anybody when they're looking at investing, you want to take your money to where it's going to be treated the best. Where am I going to get the lowest fees possible? Because that means I'm accumulating more of the assets than having to give up some of those assets in the form of expenses. And our fee is just below 1/4%, broken down between the admin cost and the investment management costs. If you look at a target date fund account online, it's going to show a total expense ratio on page 2 where it's showing a portfolio breakdown. And it'll show a total expense ratio of 0.18%. It combines the administrative percentage with the investment management percentage. Stable income fund shows a total expense ratio of 0.30%. Now, the interest rate that I quoted, 2.59, that takes into account that expense ratio. 2.59 is what's being credited to accounts. And expense ratios don't seem like a great deal of money, especially as you're starting out. But as that account balance grows over time, these expenses start to add up over the years. That's why I always tell folks, take your money where it's going to get treated the best, lowest fees possible. The academics have told us expense ratios do not impact investment performance. They've told us that higher expense ratios hurt investment performance over a period of time. So you want to keep those fees as low as possible. As you can see there, it means less money in your account when you pay higher fees. And I know when working with retirees, many times retirees get more conservative at retirement. And fees can have a bigger impact on their income potential than maybe what it was when they were actually accumulating these assets through their working career. So once you've left state employment, your deferred comp, you get to choose how these funds come back to you. What I see from folks is primarily they might be using it like a savings account, or they might be setting up what we call installment payments, where they want a certain amount sent to them on a predetermined basis. They kind of setting up a paycheck from their deferred comp, a supplement to their pension, maybe to their Social Security if they're Social Security eligible. Any withdrawals from deferred comp can be adjusted. You're not locked into a certain withdrawal amount. It is flexible. You can change it at any time. If you set up an installment payment, need to increase it or decrease it, you can. If you're using it like a savings account, you can request as many distributions during the year as you would like. These funds, how this money comes back to you is totally up to you when you start taking distributions and how often you might take them. Now, pre-tax or tax deferred money requires minimum distributions, RMDs as they're sometimes called. If you have tax deferred money in your account, and if once you reach age 73, if you were born before 1960, you have to start taking RMDs at 73. If you're one of those who were born in 60 or later, your RMD age on tax deferred money is age 75. Roth money has no minimum distribution. Roth money is not required to be paid out at any age. So this next section, we're kind of look briefly a little bit at Social Security. Here are Social Security full retirement ages. I know we're hearing a lot of in the financial press and the press in general about Social Security, Congress needing to do some enhancements to the system. These current full retirement ages were set back in 1983, I think it was, by the Greenspan Commission. We went from a 65 full retirement to this graduated schedule for those of us like myself born in 60 or later. Full retirement 67. You can still take early benefits at 62 years of age. If you take benefits early, 62, anytime before your full retirement age, 62 or any time before that, there is earning limits on how much you can earn if you're working part-time or full-time. Any funds that you are earning as employment can impact your Social Security benefit. There is an earnings limit for those that start taking Social Security early. Like I said earlier, if you have a spouses, married couple, they can kind of play each other off a little bit between the spouse that has the higher earnings in Social Security versus the spouse that has the lower earnings. And the reason is the lower earning spouse is guaranteed to receive at least 50% of the higher earning spouse's benefit. So if that higher earning spouse delays taking Social Security to closer to their full retirement age, they could potentially increase the lower earning spouse's benefit from Social Security. This is why I say it's a very good idea to go out and set an account up online and play around with the different calculators that they have. And I know we're hearing a lot about Congress needing to make some adjustments in the system. One thing they did back in '83 is the changes that went into effect only applied to those who were 40 years of age and younger. Didn't apply to anybody over that age. I happen to be in that younger than 40 years at that point in time. And I remember I was working with an accounting firm, and a lot of the partners in the accounting firm going, looking at us younger guys going, you guys got to be 67 to get Social Security. I was just hoping I'd get to 67 at that point in my life. And so when you decide to claim, this is going to work towards that income replacement ratio on the worksheet when you might claim Social Security. Like I said, age 67 is full retirement for those born in 60 or later, but when you might take Social Security, looking at the potential reduction and what it's going to replace as far as your income. And you keep hearing about 2035. If Congress did nothing for Social Security, they would have to reduce benefits for those receiving benefits at that point and those in the future. it would be more as a pay-as-you-go system at that point, but I fully believe Congress will do what they did in the mid-'80s. They'll kick this can down the road to the 11th hour, and we'll probably do something to put the system on more solid financial footing. And then we have a checklist online, kind of goes through when you might want to claim Social Security. I know I see a lot of people today who've retired under the 2000 plan. One of their big questions is, do I want to start at 62? Maybe they're still working part-time somewhere, full-time, so they have to take into account the earnings limit. Some are using their deferred comp at that point to replace that temporary benefit until they get to a point in their life where they do want to claim Social Security. Maybe they're trying to enhance that benefit, so they'll use some of their investment savings to help replace that temporary benefit at that point in time. But that checklist here is on the plan website. So this next section, I know this is everyone's favorite section, is watch what you spend, budgeting, looking at, and especially as you're nearing retirement, kind of looking down that road, what am I going to need to be bringing in to cover my expenses? Will my mortgage and rent mortgage be paid off, or will I have rent expenses? Looking at your overall expenses versus your income. I wish this, assuming this person's in the accumulation stage, should have a place up there at the very top for savings. Pay yourself first whenever you can. I know life comes at us a little fast and furious at times in a lot of different ways. And sometimes you have to adjust your budget from month to month. But setting a budget, knowing where your dollars are going, can help you squeeze out a few extra dollars to set aside for emergencies or for your retirement. And there are a number of budgeting resources available out there. I know one of my favorite websites to kind of look stuff up about personal finances, NerdWallet. They have a lot of good information on these different budgeting tools and apps that are out there today. I know Excel has a lot of templates for personal finance, tracking your income, your savings, have a lot of different tools at our fingertip. Deferred Comp has an account aggregation feature that allows you to aggregate all your different savings account, retirement accounts, so you can see it all in one place. And as I mentioned, these budgeting resources can be found at the mopocketchange.org website. This goes with another one of our webinars, the Pocket Change webinar. But mopocketchange.org lists a lot of different budgeting apps that are available to us to be able to track our spending, so we know where our dollars are going, know what our different categories are, and where that money is being spent. So this section, we're going to look a little bit at growing what you're saving. There is a difference between long-term savings and short-term savings. Short-term savings are something that you anticipate needing in a short period of time. Maybe it's an emergency fund where you're trying to set aside 3, 6, 12 months, 15 months, whatever it might be of living expenses. So if something drastic happened, you'd be able to pay your household expenses for a period of time. Maybe you're looking at setting aside money to replace a washer or dryer or one of your appliances. Something that hey, I'm going to save this money up and I'm going to need it probably in 3 years or less. And in long-term savings, like retirement, maybe a kid's education, money that you're not going to need for a while. Maybe it's 5 or more years in the future, kind of where when you look at long-term savings, thinking 5 or more years down the road. And you might invest these funds a little bit differently. Say an emergency fund, knowing that you might need it rather quickly. Folks might put those funds in a money market account, something that they don't have to worry about selling any of the assets. A mutual fund or an ETF, they can just put it into a money market account, maybe with pretty good interest rates. So if they need the money, maybe they have the ability to write checks or use a debit card against that account. I like this chart here for a couple different reasons. Number one, it's showing the time value of money. Time is our biggest ally when we're saving for long-term goals like retirement or a kid's education. This chart also kind of illustrates to the benefit of a Roth account. As you can see here, this is showing account accumulation using $100 per month. It's using a pretty modest return of 6% over a period of time. But what they're showing is if this account that you're putting $100 a month in averages 6% annual return up until age 65, what the projected account balance would look like. What's in blue there is going to be the contributions. What's in green is the investment growth. Now keep in mind, if you're investing and you're fairly young and you could earn a higher return at 6%, you're going to have more in the growth. The bottom line is actually going to be a little bigger, but it gives you a good idea of how the Roth option works. You pay taxes on what you contribute in the blue. You get the investment growth back tax-free. So folks that have Roth accounts in many cases are investing those funds rather aggressively sometimes because that investment growth is going to be the tax-free portion of that particular account. But time is your biggest ally when it comes to saving for retirement. Wanting to put that money away as long as you can, automate these type of savings so that you don't have to make a decision each pay period on how much you want to put into an investment account, automate those contributions. And this chart kind of gives you an idea here between long-term savings, short-term savings. Most cases with short-term, we're going to use a little bit lower interest rate. So that local bank CD, what's interesting to me about this is the Federal Reserve is shooting for keeping inflation at 2% rate or lower. Their benchmark is to keep it at 2. That's why they've been raising short-term interest rates, and we're seeing a lot of CD rates much better, almost double at 2%. They raise short-term rates to kind of help offset inflation a little bit, to discourage people maybe from borrowing money, but it also helps with savings. But again, if they're using a 2% annual rate, that $30,000 that $100 that you've been putting away for 25 years, you would need about $39,000 to purchase same goods and service at that point in time that you would have with that $100 at no rate of return. If you average a 6% rate of return on those funds, then that account balance is going to be just over $67,000 at that point in time. Inflation is something you're trying to overcome when you're investing for long term. Hence, a lot of times they recommend that we take some risk with these funds that we're investing for a long period of time. Even when we get to retirement, we may not need all the funds that we've accumulated right away. Rather, we might need that over a 15, 20, 25-year retirement. So we might have a portion of our funds still invested to grow over those retirement years. So let's wrap this all together. We did have a retirement income worksheet, complete your retirement paycheck worksheet that was in the handouts. And some of this is going to be impacted by how long you've been with the state, how much of your income will your state pension replace. Maybe you had a pension from a previous employer. We're fortunate enough to work with somebody who also had a pension. Then your Social Security will probably replace around a fourth of your income. So, and it also is going to depend upon when you hope to retire or plan to retire. Let's not say hope, let's say plan. You want to plan to retire. And so how much will you have to depend upon for personal savings versus a pension and your Social Security benefits? So if you take out the complete your retirement paycheck worksheet here, we're going to be looking at our current account balance. And one thing I would do here, like it says here on the chart, pull all your assets together that you're earmarking towards your retirement. If you're contributing to IRAs as well as deferred comp, look at the big picture. What am I going to have once I retire at that age? So we're going to look at number one at the defined benefit. What is our pension going to replace? And if you multiply your years of service times 1.7%, that's the multiplier, base benefit multiplier for 2011 tier retirement plans. Years of service times 1.7% will tell us the income replacement ratio. This person with 26 years of service, the pension's going to replace 44% of their salary for as long as they live. I know Julie may have talked about this, but it's not here. Some of you may qualify for the temporary benefit if you can retire before age 62 under the 2020-11 tier. If you're one of those who are eligible, you might want to include that temporary benefit. But this base benefit is what you're going to receive as long as you live. And then what does your Social Security income replacement ratio look like? And that's in the second step here. What do I expect to get from Social Security? I'm going to try to build this around 100% replacement ratio. So looking at the age that you might take Social Security, if you're taking it before 2035 and at 2035 or after column, that's with a potential reduction if Congress did not make changes to enhance the financial solvency of Social Security. Like I said, I think they will. They'll just kick the can down the road to the 11th hour. So if you want to use 100% replacement, some of us may not need it total 100%, but if you take 100% and subtract your income replacement ratio of the pension and Social Security, it'll leave a difference there, in this case 26%, what the individual's trying to replace on their own to achieve 100% income replacement ratio. And the fourth part here, we're going to take our current account balance, deferred comp, IRAs, like I said, look at the whole picture, take into account our annual salary. What are we currently contributing? And looking at the auto increase amount. Are you using auto increase? And then how many years to retirement? This person's 17 years and they expect 25 years in retirement. At their current contribution, they would replace just over $44,000 of their account balance at retirement age. That'd be about a 5% income replacement ratio. Now, what you're wanting to do here, this next step, there's the Grow Your Savings calculator. And we saw in the previous example, the person is wanting to replace 26% of their income at retirement. And here you can put in the entries, the current balance, your salary. Most of us are paid semi-monthly. There's the auto increase, the contribution cap per pay period. This allows you to cap the auto increase feature at a certain dollar amount or at a certain percentage, depending upon if you're using a dollar amount or a percentage. And then it's going to project out that account balance at retirement. And the years in retirement are going to be used to determine the annual income in retirement as well. So we're trying to accumulate a large enough account balance that will provide income to us in our retirement years. And you can play around with this calculator. The table version is helpful. It's going to break down, as it shows you here on the screen, if you're using the auto increase feature, what the annual auto increases would look like. This example here, this person says, hey, I want to start off with a 5% annual contribution at $38,000. It's showing 5% is $79.17 a pay period. We're going to increase that 2% annually over their working career. And it would show you at the end of their working career potential salary. There is an annual salary increase built in, and it uses a 1.5% annual salary increase over those remaining years up until retirement age. And so after playing with this, the Grow Your Savings calculator, now you have the different scenarios to help you determine what it is you're going to need to replace through your own savings. And like I said, in this case, we were shooting for 100% replacement ratio, but depending upon somebody's lifestyle, they may or may not need their full income in retirement. And so you might play around. I know financial academics say most people need anywhere between 85 to 100% of their salary, depending upon lifestyle, assets, if they're still paying on a home, farm, or something like that, or they got a vacation home. All kind of depends upon each individual's lifestyle. And down there at the bottom, you can play around with the different scenarios and how you could accomplish that goal. That auto increase feature is a handy tool, allowing you to set money aside for helping you determine what that account balance is going to be, how much you might need to change that on an annual basis. So after you have figured some of this out here, you can go into deferred comp. Keep in mind, we contribute to the 457. You can click on the change contribution box, enter in the new dollar amount, the new percentage. You can also, this is where you can utilize the annual auto increase feature as well. You can set up an annual auto increase. I see a lot of people use their anniversary date of employment and set their auto increase up at that point in time, but you can set it up at any point. You can always adjust these contributions as needed. Throughout the year, we don't have any enrollment periods with deferred comp. And then we also have the pocket change webinar. I mentioned that a little bit, and that goes a little bit deeper into some of these different topics. There's also the retirement track calculator. This is a handy tool. This is going to take into all sources of income coming in, as well as estimating some of your expenses. You'd have to estimate what you expect some of your expenses to be in retirement, kind of give you an idea of what type of income you might need to be drawing from your savings to help supplement your pension and Social Security during retirement. The retirement track calculator does have more inputs. There's more variables that you can play around with this, so it'll give you a little bit bigger picture view of your retirement income versus your expenses. And this year, we're going to be changing record keepers. Right now, we have Mission Square as the record keeper, and you see some of this on the website, and any correspondence you might get, it'll say Mission Square. Mission Square is the record keeper for deferred comp, and they've been the record keeper since 2011. But this fall, we're going to be transitioning to Voya. Voya is going to be the record keeper in the plan. Everything should stay pretty much the same as far as the investment options, the tools that we have, but we will be transitioning to Voya as the record keeper sometime this fall. More information is going to be coming out about the transition process. This will be my fourth transition from a record keeper in the years that I've been with deferred comp. Few things that you have to be aware of, but there will be more information coming out later on this year as we know more about the transition to Voya. And here's your deferred comp website. Mission Square office is located on American Avenue up behind Lowe's here in Jefferson City. You can access your account through the plan website, also through ESS. You can access your account, the employee self-service portal. We do have an app. If you're managing your account online, you can download a copy of the app. A little bit more conducive to the smaller devices, but you do sometimes have to kind of shift your phone around between horizontal and landscape mode. And this is a territory map for education professionals. If you have any questions, please reach out to us. We'd be more than happy to help you. If you want some help understanding that Grow Your Savings calculator, reach out to your education professional. We would be more than happy to assist you with any questions, help kind of take some of the guesswork out of this and help you get set up for a comfortable retirement that you have kind of planned for, and set that time. Don't hope for a good retirement, plan for a good retirement.